Hey everyone, and welcome back to The Explainer. Today, we're putting on our investigator hats and acting as the data detective. We're going to break down the incredibly dense financial metrics of an absolute industrial giant, Emerson Electric, ticker symbol EMR. If you love dissecting a company layer by layer using hard data, well, you're in exactly the right place. We're going to strip away the noise and look strictly at what the numbers tell us about this massive enterprise. So grab your notepad and let's dive right into the financials.
Here's our quick roadmap for today's explainer. First, EMR stock at a glance. Second, historical returns. Third, the dividend story. Fourth, valuation multiples. And finally, fair value and safety.
Okay, Section 1, EMR stock at a glance. To put things into perspective right out of the gate, we're dealing with a massive $74.42 billion market cap. You know, this isn't some volatile small-cap startup just hoping to find its footing. We're talking about a heavy-hitting, deeply entrenched enterprise with a huge footprint. When we evaluate the metrics coming up, it's absolutely crucial to remember that we're analyzing a massive ship, and well, a ship naturally steers differently than a speedboat. Let's ground ourselves in EMR's current reality. The latest closing price sits right at $133.05. But you know, context is everything, right? Looking at the 52-week range, the stock hit a high of around $165 and a low of just under $115. So, at 133, it's hovering somewhere in the middle to lower range of its performance over the last year. Actually, it's down over 19% from its 52-week high, yet up nearly 16% from its low. That tells us we've seen some pretty significant price movement recently.
Moving on to Section 2, Historical Returns and Growth.
Now, the numbers here perfectly illustrate the long-term wealth-building power of EMR. We're looking at the total return compound annual growth rate, or CAGR, across 3 different periods. Over a 3-year stretch, it's an impressive 18.58% annually. Now, over 5 years, it cools down a bit to 9.14%, but stretch that out over a 10-year horizon, and it's a very sturdy 12.57% per year. These figures basically prove that historically, EMR has had a really strong, consistent growth trajectory. If you've held this stock over the last decade, well, it's done very well for you.
But hey, as data detectives, we've got to look for cracks in the foundation too. What's super interesting here is the stark contrast in return on equity, or ROE. The 3-year average ROE is a stellar 28.07%. But consider the current ROE, it's plummeted to just 12.04%. That is a striking drop of over 57%. Since ROE measures how efficiently a company generates profits from its shareholders' investments, this steep decline is a major clue. It hints that the company's recent capital efficiency might be cooling off quite a bit compared to its recent past.
All right, Section 3, the dividend story.
Just pause for a second and really take this in. 68 consecutive yearly dividend increases. The crucial takeaway here is this. Through economic booms, massive recessions, inflation spikes, and global crises over nearly 7 decades, Emerson Electric hasn't just paid a dividend, they have raised it every single year. It takes incredible financial resilience, massive cash flow generation, and serious management discipline to achieve a streak like this. It is literally a legendary track record.
But how much of their pie are they actually giving away to keep that streak alive? The payout ratio currently sits at 50.52%. I absolutely love this metric because it shows perfect balance. EMR shares just about half of its earnings directly with you, the investor, while keeping the other 49.48% retained within the company. They use that to fund operations, pay off debt, or reinvest for future growth. It's a really healthy, sustainable split that strongly suggests the dividend is safe.
Now, a great streak doesn't always equal a massive yield today. The current dividend yield is sitting at exactly 1.67%. While that 68-year history of hikes is undeniably amazing, this current yield is actually a bit below its 3-year average of 1.81%. It's a respectable yield for sure, but it tells us we're paying a price today where the yield is slightly compressed compared to the recent historical norm.
Let's dive into Section 4, Valuation Multiples Explained.
Let's kick off our valuation checks with the classic price-to-earnings, or PE ratio. The current PE ratio for EMR is 30.73. Now, let's compare that to its own 3-year average, which is 25. The math here is pretty undeniable. EMR's current price tag is running nearly 23% hotter than its recent usual valuation. The market is definitely demanding a premium right now for every single dollar of EMR's earnings.
And if you thought the PE ratio was running hot, consider the PEG ratio, 9.20. As a quick reminder, the PEG ratio measures the PE ratio against the company's expected earnings growth, and typically, a PEG around 1 is considered fairly valued. EMR's current PEG is up over 9,000% from its 3-year average. To translate that for our investigation, a number this high is a massive flashing warning signal that future growth is already heavily priced into the stock right now.
To confirm this narrative, we just need to quickly run through these supporting multiples. EV to EBITDA is at 15.30. Price to sales is at 4.06, meaning you're essentially paying $4 for every $1 of sales, and price to book is 3.67. While these measure completely different parts of the business, across the board, the conclusion is exactly the same. EMR is trading at a robust premium valuation. You are paying top dollar for this industrial giant today.
Which brings us to our final act, Section 5, Fair Value and Safety. This is the ultimate question we've been building towards. We know the price is around $133. We know the market absolutely loves that 68-year dividend streak. But when we run the quantitative, discounted cash flow models, looking purely at the cash the business is actually expected to generate, is the price actually right?
Well, according to the discounted cash flow metrics from our data sources, the fair value price of Emerson Electric is exactly $79.13. This is the estimated intrinsic value of the company per share based strictly on its free cash flow generation.
Let's put those two numbers side by side so we can really grasp the reality of the situation here. You've got the current market price demanding $133.05 per share, and right next to it, the DCF fair value is sitting way down at $79.13. That is a massive gaping chasm between what the stock costs today to buy on the open market and its mathematically estimated intrinsic value.
Which leads us to the absolute bombshell of our investigation, the margin of safety. It sits at a strikingly negative 68.15%. Now, in value investing, you want a positive margin of safety, right? The idea is buying $1 for 70 cents. But here, the data suggests you are paying significantly more than $1 for $1's worth of value. It serves as a massive plot twist to our seemingly perfect dividend-paying juggernaut.
And that leaves us with this final provocative thought. Emerson Electric is undeniably a brilliant company. 68 years of dividend increases and solid historical market returns prove that beyond a shadow of a doubt. But the data today shows a heavily overheated price tag, dropping returns on equity, and a deeply negative margin of safety. A phenomenal history? Absolutely. But is the premium too steep for your portfolio right now? That is the question you have to answer. Thank you so much for joining me on this explainer. Keep trusting the data, keep asking the hard questions, and I'll catch you next time as we decode another incredible data set.